Suppose you want to use cash flow in our portfolio to fund future acquisitions. So that's correct. Everybody in my audience watches that. Yeah.
Yeah. Yeah, absolutely. So the point here is that because an LLC is a pass-through entity, even if you as the member never take a cent out of that LLC, you still pay tax, right? That $1 million of profit, the IRS disregards the LLC for tax purposes. It shows up on your personal tax return, and you owe income and payroll tax on $1 million, even if that $1 million never gets taken out of the LLC.
Yeah.
Now, you can shift some expenses, right? You can prepay rent and kind of get into the accounting game to
Buy
kind of
a
lower
big 3/4 ton truck before.
take
Yeah.
your take your 179. Yeah, no, absolutely. So there's some games you can play there, but the point is, if you're a member and that LLC has profit but you don't get money out, doesn't matter. You pay tax. And where this becomes really important is where you're maybe an investor in an LLC and not an operator, right?
Yeah.
I have a sizable investment portfolio of private investments in LLCs, and every tax season I have to deal with phantom income, right? I get a K1 that says on paper I earned $100,000 this year, but I never got a distribution, right? The LLC has kept that money for now to be able to fund future acquisitions or something like that. The IRS doesn't care. I have to pay income tax on that $100,000. And so what ends up generally happening in the way most LLCs are structured is that the LLC has to make a mandatory tax distribution to the partners, the members each year, to at least cover the tax obligation of whatever profit they're deemed to have recognized,
Yeah.
right? So if you have the $1 million and you want to save that $1 million for a rainy day or to fund an acquisition next year, you're going to distribute out up to half of that money just to fund your members' tax obligations for the year. So on $1 million of profit, you're only left with $500,000 for future funding.
Yeah.
The C corp doesn't the C corp doesn't operate like that. If it's a C corp, you pay your 21% corporate income tax. So on $1 million, what is that? $210,000. You're left with $790,000 in the war chest that your shareholders don't pay any tax on because they haven't received the dividend.
Right.
And so that's what this corporate development benefit can be, is that if you don't plan to make distributions and you don't have a cash flowing investment strategy, it could be that a C corp makes a lot of sense for your entity so that you can block and trap income in that C corp and redeploy it on another acquisition next year. It preserves more of your capital that you don't have to distribute out to cover tax.
Yeah. That's perfect. Yeah. Yeah, we just talked about it.
Yeah, that's what we're talking about there.
Yeah.
So I put a little example for your viewers that want to go find that link and
Yeah, I'll put the link in the comments down below on the videos.
It's back of the napkin. If you're a tax pro, don't yell at me in the comments. I kept it very simple. There's some nuance of things, but I wanted to keep it high level.
Right, right. All right, so let's move it down. So dividends received deduction, building on number 2. Yeah.
Yeah. So here's another benefit of using a C corp, right? So, like we said, with a C corp, you pay a corporate level income tax at the C corp level where you recognize the profit, right? And then when you send money out, you pay an additional dividend tax, right? What the dividends received deduction says is that if you're a C corp owned by another C corp holding company, depending on how much that holding company owns, you can deduct a portion of the dividends that you receive and not pay dividend tax on it. And in fact, I believe the threshold is 80% for 100% deduction. So if it's a wholly owned C corp, or you've got a few minority shareholders, but you own 84% or whatever, any of those dividends that you send up to that parent C corporation, you don't have to pay. You get a deduction for the dividends tax. So this eliminates a large part of the problem of what we were talking about earlier. So you can pay that 21% corporate income tax in the operating C corp, dividend the rest up to the parent C corp, they take a dividends received deduction and pay no additional dividend tax, and then they can redeploy that capital out into, for example, a different subsidiary where they want to make another acquisition.
Yeah.
So it lets you move some of this capital around your organization without realizing all of those layers of dividend taxes as you move it up and back down in your structure. So it can be a very powerful tool if you go down the C Corp route to keep your tax exposure low while redeploying cash outside of that one subsidiary instead of keeping it.
Thanks for watching this video. Make sure you're a subscriber by clicking on this button right here down below. And if you want to watch more serial acquirer interviews, click on this button right here. If you're ready to buy your first business, get my course at dealflowsystem.net right here. Take care. Cheers, John.